Hey Rick, how are you today?
Doing well, Peter. How about you?
I'm good, thanks. So before we get into it, I like my guests to kind of give some context to everybody that's listening, to give a background on kind of who you are, how you got into real estate, and kind of your, full evolution to where you are today.
Oh, how much time do we have, Peter? Been in the business for a long time. Um, I'm kind of an accidental tourist in the real estate business, to be honest with you. I spent the first half of my career doing marketing for technology companies, big international firms like Toshiba and Hitachi, and then little startup firms as well. And began consulting for a startup company called RealtyTrack back at the end of the 1990s, beginning of the 21st century, and that was my first sojourn into the world of real estate. RealtyTrack was a regional website that licensed bank-owned property information to realtors in California, and was under new management with a plan to expand nationally and make foreclosure data available to real estate investors and real estate agents, sort of democratize that data that had been insider only for a long time. And I happened to be at RealtyTrack when the foreclosure crisis hit, just before the Great Recession. And we were the only company willing to share data with the press about what was really happening in the way of foreclosures. And for the better part of the next decade, I was one of the most frequently quoted people about real estate in the media because of how many relationships were formed and how much information we were willing to give out during the foreclosure crisis. So I spent about a decade with RealtyTrack. I spent a few years with a company called Carrington Mortgage Holdings that owns and operates, real estate brokerage, mortgage origination business, mortgage servicing, title company, the whole nine yards. And then spent about 5 years with auction.com and 10X. Auction.com is still the largest online platform for the sale of distressed properties. And then in a full circle moment, came back to ATTOM Data Solutions. ATTOM is the parent company of RealtyTrack. And I came back initially to help relaunch the brand. We recently sold RealtyTrack to a company called Nations Info Corporation. And in my current role, I'm the executive vice president of market intelligence for ATTOM. So I spend a lot of time talking to people like you and others in the industry, sharing the learnings we take from our database. ATTOM is one of the largest providers of real estate related data to the real estate, mortgage, and insurance industries, as well as educational institutions and government organizations. So it's I'm a little bit like a kid in a candy store because now I get all access to all of this data regarding real estate, both residential and commercial, and have lots and lots to talk about.
Yeah, I mean, I've heard you on other podcasts, and I was super excited to get you on just because you have so much. I mean, your career path, as what you just lined out there, is someone that's very involved with data, takes data to, the 30,000 foot view and brings it all the way to ground level. So that was my biggest reason to get you on, is to really hone in on kind of what, you've seen across your career, and then also what you're kind of seeing today. With all that experience, what would you kind of quantify, the last 5 to 10 years with real estate on how, well, not so much like a market standpoint, but data standpoint, where it's gone just not across real estate, but just as a technology as a whole for the world. But what have you kind of seen some wins and some losses on technology for helping out realtors and professionals in real estate?
Yeah, before I go there, one of the things I failed to mention is I do have a sort of a soft spot for real estate professionals and real estate investors. Virtually every business that I've been part of in the real estate industry has worked with those professionals, and so I've had a chance to interact with a lot of those people over the years. And candidly, that's helped me understand some of the gaps in what data has been available over the years. So getting to your question, I thought you were going to ask about, how to describe the market over the last 5 to 10 years, which could take an entire podcast by itself. Certainly nothing like a normal housing market. And well, I'm sure we'll talk about that in more detail. But it's been interesting to see sort of the evolution of data in the real estate and mortgage markets. Still some of the data with the highest amount of static in it of any industry that I've seen. It's still collected in very archaic ways by a lot of counties across the country. There's very little in the way of data standards. And so what ATTOM has done is we've aggregated data that's recorded by the county recorders, so transaction data, pretty much across the entire country. We probably have data that covers 90 to 95% of the population. Although if you're looking for a particular property in Moose Jaw, Montana, we may not have it. We have tax assessor data from across the country. We cut our teeth in the market on foreclosure data. We probably have the most comprehensive set of that data available anywhere. And then we started adding to it. And I think this has been one of the big changes we've seen over the last 10 years in the real estate market when it comes to data, is you had all of that stuff I talked about, which is basically transactional data, property characteristics, and things like that. Now you start appending to that information about the loan, information about demographics, information about local market conditions, whether it's school ratings or crime rankings, environmental risk, most recently things like climate risk, even noise levels. So you see things like those aspects coupled together. And I think a lot of the emphasis, a lot of the focus rather on data in the real estate industry, really for the last 100 years, has been on finding ways to collect the data. The next two steps, which I still think the industry is in its infancy on, are finding better ways to deliver the data to customers who use it, and then making the data itself more usable and more contextual for those users once they have it. And that's been a lot of our focus. For the most part, real estate data is still delivered via flat files, massive data dumps onto FTP sites. We now have that option, of course, but we also have APIs, and we just recently launched a cloud-based solution, which is similar to how a lot of people are buying software these days. It's sort of data as a service, so that the user doesn't have to house the data. They don't have to integrate it into their own systems. They don't have to worry about whether it's the freshest set of data because it's updated on a real-time basis. And so I see that as kind of a huge evolution in the industry in terms of data delivery, data deployment. And then the next step really is to learn from how customers are using it and to make that data, again, more contextual and easier for them to use in ways that are accretive to their business. So that's a lot of what I've seen in terms of changes. It's the addition of ancillary data types to the core real estate data, and those usability and deliverability aspects.
Do you think, and I know you're not an expert in this, but do you think, because I've seen, I've tried to always stay ahead of, or at least on top of, giving data to my clients and then also people that I work with. So do you think at times it's also a, receiving the information and, going out and gathering it? Because some people, especially in real estate, I feel like, just like you said, it's more of an archaic marketplace and also industry. So I think that trickles down to the people that are on the boots on the ground, where they also have that mentality where they don't pull the data out for their clients as much as maybe somebody that's, doing a startup or something like that.
Yeah, that's an interesting observation, Peter. I do think I'm seeing more and more realtors, in particular, real estate professionals, who are starting to tap into data sources, and a lot of that's available for them for free through their local MLS, and using that to kind of become a real estate counselor and advisor, providing really useful information to their local markets, sales trends, price trends, and the like. I hesitate to say that's terribly widespread. I've seen companies create businesses where they kind of spoon feed that information to the realtors to use in their marketing.
Hmm.
But I do think you have some realtors who are leading the way by doing that on a personal basis, and I think they're providing a valuable service for their clients and prospects.
Yeah, for sure. And I say that lightly just because I know some people provide a significant amount of data, more so than the next person, and same thing across any marketplace. However, what I've seen is it's been slow, but it started to pick up where people provide that information and the industry provides more, just like ATTOM and everything else, where they're providing more information so people can take it back to their clients or their database and give them tangible information so they can go make a sale, or those people can sell with an educated decision versus not being well educated and just kind of shooting from the hip.
Yeah, the only scary part for me is I see a lot of a lot of people who, at least to me, it seems like they're misinterpreting the data. And data in the wrong hands is a little bit like giving a 4-year-old a loaded bazooka sometimes, and being surprised that that the result isn't necessarily all that positive.
Yeah.
I am sick to death of reading social media posts about how the housing market is about to collapse. We're gonna have Great Recession 2, another housing market crash, collapse. Don't buy anything now because prices are going to be down 30, 40, 50% before you know it. And they'll take one tiny little data bit and use that as the premise. And so that part does concern me a little bit. The internet, I was a journalism major in college. So on the one hand, I look at the internet as the ultimate publishing vehicle.
Yeah.
And on the other hand, I'm just crestfallen that anybody can become a publisher now, because some of them really shouldn't be putting out any information. And we have the same issue with real estate. It's good to have the data available, but again, if it's misused or misconstrued, it can you can lead to people coming up with exactly the wrong conclusions, and that can be a little frustrating as well.
Yeah, and I mean, I think what you kind of made reference to is you got a lot of clickbait, people trying to get to more money, more revenue, and stuff like that. So they put one headline, but and it goes both ways. The people writing it and also the people reading it, where they just read the headline and then that's it. And they said, okay, well, hey Rick, now the housing market is going to crash. I think that has had a tailspin the past like 10 years, where you don't gather all the information and take here's an hour's worth of data each day for the last 3 months, and this is what I see, right? It's
Right.
Here's a second of my day that I put into researching because I saw a headline, and then it worries people. So I think
a good example of what you just talked about, Peter, is the media recently has picked up the term housing recession. Now, we've never had a housing recession before, because I don't even know how you would define that. If you talk about an economic recession, the general definition is 2 consecutive quarters of negative GDP growth. Mm-hmm. Although economists will tell you that just because we've had those recently doesn't necessarily mean we're in a recession, because all the other criteria aren't being met right now. We created 580,000 jobs last month. That doesn't feel like a recession. Yeah. But somebody breathed the phrase housing recession, and all of a sudden I'm seeing media headlines everywhere about whether or not we're in a housing recession. So the clickbait part is bad enough. So if you read a headline that says housing market about to crash, here's what you need to know, and you click on something, that's not great, but it's relatively harmless if you can click right out. It's the people that are doing YouTube videos where they spend 15 minutes misinterpreting data, or worse, doing it on purpose so that they can sell you something. And right now, I would tell any of your podcast audience to be very, very suspicious of anybody who's trying to sell you anything based on a housing crash. Yeah. Because the data, if you really parse the data, you really go through it, doesn't suggest we're looking at anything like that in the foreseeable future.
Well, let's dive into that. I mean, I know you're data driven. That's, the first 15 minutes of the conversation was talking about really, your background on how much data you've, collected and also you've done for ATTOM and multiple companies. So what have you seen the last, couple of years, especially with once we hit COVID and the lockdowns and everything like that, and then forward till today? What have you kind of seen, and what do you see going forward?
Well, I tend to think that history is a relatively good predictor of future trends. And when COVID hit, it was declared a pandemic. The truth is nobody knew what was going to happen. We didn't know how long it was going to last, how bad it was going to be, what the economic repercussions were going to be. The government jumped in with some unprecedented programs that propped up the economy and to a great extent propped up the housing market. But one of the things I did is I went back and took a look at the housing market through prior pandemics and prior periods of economic shock like 9/11, where everything just stopped for a period of time. And what I found was that in every one of those events, going back prior to World War II, the housing market actually performed better than the overall economy and typically grew from the beginning of a recession to the end of a recession, both in terms of prices and sales. So, history was sort of a precedent for me in that housing, as a general rule, helped the economy recover during those periods, with one exception. And the one exception happened to be the Great Recession, our most recent real big recession. And that was largely because housing dragged us into that recession. So it was a very, very different cycle that time than prior cycles. And I think everybody's still suffering from PTSD from the Great Recession, because now you look at a data point. You say, look at how far home prices have gone up. Okay, that's true. Home prices now exceed the price peaks they hit during the run up to the Great Recession. Mm-hmm. But then you have to start looking at what's different this time from prior cycles. Last time there were 15 million people with adjustable rate mortgages that were really bad adjustable rate mortgages. These were loans that were issued to people who probably didn't qualify for a loan in the first place. Many of them were issued with teaser rates. So you got a loan with a 0% or 2% interest rate for a period of time that was then going to reset to market rates. So you might go from 2% to 6% in a month. And people looked at that and said, oh, that's only a 4% increase. No, that's a 300% increase because we're bad at basic math. And so all of a sudden, you had all these people who couldn't afford to make their mortgage payments. And as long as home prices were going up, you could sort of paper over that, because now your way out was to sell that property at a profit and move on. Yeah. But if your loan reset when the housing market peaked and you weren't really financially able to make those new payments, you were in trouble. And that's one of the reasons we saw foreclosure spike. Another big difference is the builders didn't get the memo last time. So housing starts were at historically high levels all the way through 2006, which meant builders were still building after the market had peaked. So we wound up with a 13-month supply of homes entering into what wound up being the Great Recession. In a normal market, you have about a 6-month supply. So we had more than twice as many homes as the market would be able to absorb. In today's market, even with the recent increases we've had in inventory, you're looking at about a 3-month supply. So it's still only half of what you would normally need for a market to have a sense of equilibrium. So you had all these bad loans. You had people who were forced to sell a property. You had negative equity in about a third of all mortgages. And in today's market, we have almost $28 trillion in homeowner equity, an all-time record. Our data at ATTOM shows that 90% of borrowers in foreclosure actually have positive equity. Yeah. So they have an opportunity to sell their home at a profit rather than lose it to foreclosure. That wasn't an option for a lot of people in the last cycle. And the only way you're going to see home prices really crash is if people have to sell their homes into a declining market. That's what we had 10 years ago. In today's market, if you're sitting on a 3.5% mortgage and you have 40% equity in your house, if you don't have to sell your house, you're not going to sell it. You're going to wait for market conditions to improve. So, Boise property values went up 45% last year. Yeah. Do I think they may trek back a little bit from that this year? Yeah, probably. But if Boise property values are down 10% after going up 45%, does that sound like a housing recession to you? It certainly doesn't sound like one to me. So the conditions at play right now, delinquency rates being lower than historic levels, foreclosure rates being at half of their normal historic levels, inventory being at half of what we would normally want to see, record levels of homeowner equity. It just the market conditions couldn't possibly be more different. So the most likely scenario, and this is pretty consistent with everybody else whose work I follow, is that we will continue to see home sales decline because of affordability issues. We're still seeing prices go up, by the way, but that home price appreciation will start to slow down as sales volume slows down. Prices will probably plateau. And then we'll start to see home price appreciation in the low single digits. So instead of going up 20% a year, maybe the prices will go up 2% a year. And that's one of the other misnomers. People believe that as interest rates go up on mortgages, home prices come down. The truth is, historically, that hasn't been the case. What's been the case is the rate of home price appreciation has slowed down dramatically as interest rates have increased. So again, in your local market, conditions may vary. Could we see some markets where there are price declines, not just slow down of growth? Yep, we could. We probably will. But nationally speaking, the market's very, very unlikely to crash.
And all that stuff. And like I said, I've heard you before on podcasts, and all those fundamentals are there. And I agree with you on. I try to read as much as possible So most people will come to me and they hear all the stuff on the news. They'll read it on, like you said, Instagram. They'll read it on YouTube, or they'll see it on YouTube and all this other stuff where people are trying to either sell something or they're trying to get them to watch their video to get more subscribers, ultimately. But I continue to read when we were on a run up just in Southern California. So on a micro scale, in all counties, LA, San Bernardino, Riverside, Orange County, and in San Diego, there was about 120,000 listings active that were going as we went into the recession. So about 2008. And then right now we're at about 19 to 20,000 active listings across those counties. So if you look at it, it's 5 times difference, 6 times difference. And which that means is people still don't have the option. Granted, affordability isn't there, right? So they can't come in and say, I'll continue to pay this much for this, and I'll just continue to throw money at it, because those interest rates went up. And on happenstance, they came down just a little bit the past couple of weeks. But that being said, there's still the opportunity where I don't think that we're going to be sitting in all of a sudden a flood of inventory. Like you said, the delinquency is not like what it was before, not like it was in 2008. The inventory is, not there where people can still make, it's up, so people can make other decisions. You and I go to take a look at a house. There's 5 other houses in that same city that you like to. 6 months ago, a year ago, there was 1 house, maybe, in that same city.
And everybody you knew was outside waiting to make a bid. Yes.
Yeah, exactly. So you used to have 10 to 12 offers. Now you have maybe 1 in the first month, just because people have scaled back because they want to make sure that they're cognizant. And there's a lot more lending requirements going into it. Like you said, there was a lot of bad loans, and interest rates were, different. People were getting the arms that were a little sketchy comparatively to what they are today. And they weren't being educated on it either. I think that there was a lot of times where, just like, the tread, where you have to have a CD out for 3 days before, they actually get it back, get docs out and everything else. There's a lot of things with Dodd-Frank, but not to ramble on. I think that we're far away from it, because we have the going back to the foundation of a very solid market. Granted, I wasn't in real estate 10 years ago like you were, but just reading the trends and seeing what it looked like then and what it looks like now, I think we're still in a great place.
So we are, and it's funny. You're very well versed in real estate, obviously, and even though you weren't around during the Great Recession, which is probably good. You're not scarred like a lot of other people are. But I think we've collectively forgotten what a normal housing cycle looks like. And that's understandable, because we went through an historic boom followed by the largest bust in the history of the housing market. By the way, worse than the Great Depression. We've never had anything like that. This will show you that I desperately need new hobbies, but I was researching the last 100 years of home prices. And the only time we've had a sustainable period of a 20% drop in home prices was during the Great Recession. That's not to say that home prices never went down for a while, but they never stayed down, and they just kept going up. Anyway, the way a normal housing cycle typically works is you start to see the economy picks up. You start to see more people buying houses. Sales activity picks up. As sales activity picks up, prices go up. Mm-hmm. When prices get to a certain point, people who want to buy houses say that's just too much money and stop buying. And then sales volume drops. And as that happens, prices come down and you go through a new cycle.
Yep.
That's where we are right now. The big difference in this cycle, and I think what has people a little bit alarmed, is how rapidly the changes hit. I mean, that cycle I described typically takes a while. Yeah. In June, nationally, home sales were off by 15%.
Okay.
July numbers just came out from the National Association of Realtors. They're off 20% on a year-over-year basis. In California, the numbers have been even more severe. I believe in June, we were down statewide about 20% in sales. I haven't seen the July numbers yet, but I suspect they'll be down even further. Part of that's the lack of inventory you mentioned. But to me, the big variable here is how high and how quickly interest rates on mortgages went up. I have a friend who's an economist at Freddie Mac. He's posted a lot about this. That 2% jump on a percentage basis was the highest we've seen in this short a period of time since the 1980s. And you just don't see that big a jump in mortgage rates normally. Those low rates we got used to were the reason home prices continued to go up and sales were happening as rapidly as they were, because as wages went up and interest rates stayed down, that sort of offset how high home prices were. So the people that got into those loans could afford them because of how low interest rates were. But because of the combination, and this is particularly true in California, because of the combination of rising home prices and interest rates that virtually doubled in a year, if you bought the same home today that you could have bought a year ago, your average mortgage payment is up between 40 and 50% a month. And I don't know about you, but my boss didn't get me that 50% raise I was hoping for.
No.
And I think for most prospective home buyers, that's also the case. So a lot of people who were interested, who were potential home buyers, suddenly found themselves priced out of the market, or suddenly found themselves not qualifying for a loan anymore because of how much more expensive it was. And it's going to take the market a while to adjust to these new interest rates. So the first thing we'll see is home sales decline, which we've seen. We will see home price appreciation rates drop. And I believe the latest number I saw in California was about a 9% year-over-year increase, which is the lowest increase we've seen in a few years. Mm-hmm. And you'll also see buyers adapt their buying strategies. They will start to drive further into the suburbs. They will start to look for smaller properties. So they'll do what they can to buy properties that are now within their new buy box, rather than continue to, kind of go after the properties they can't afford anymore. But that doesn't mean that home prices are going to crater because that buyer can't afford it. Again, if you're a homeowner who doesn't have to sell a house into a weak market, you just wait it out, and eventually the market will come back to you.
I got a question actually that was a question I was going to ask earlier. So you have the boomers, which is what, like 78 million people roughly?
It's something like that, yeah.
So, and then you take those people, and then let's say you add in, I know the millennials are a bigger footprint of population, but you add in those people, then the millennials that bought when it was 2%, 2.5%.
Yep.
What have you pulled data or have you seen? And I know it may take a while, may not take 6 months, but have you seen, okay, well, you have the boomers that maybe have their house paid off. They're not going to be, moving as much as the millennials and Gen X, I believe, or Gen Z, but correct me if I'm wrong.
They're both out there.
Okay, all right. So they're both out there. Well, my main question is okay. Well, you have a subset of people that have a very low interest rate at 2.5, 3%. Then you have the boomers that maybe have their house paid off or two houses paid off, and they're not moving either. So it's almost like this Cold War where no one's moving. Have you kind of pulled that data where?
We haven't pulled it specifically. I can tell you that over the last few years, the length of time somebody stays in the house has increased. There's some data out from First American Economics that talks about tenure, and mortgage professionals tended to look at, when they issued a loan, they expected somebody with a 30-year fixed rate loan to stay in the property 5 to 7 years, because that had historically been about how long they stayed there. That number has gone up to over 12 in the last couple of years. And that's largely the baby boomers aging in place. And that has been a conscious decision that boomers have made, that unlike prior generations, they've opted to stay in place. They've either paid off their house or they paid off most of their house. They're taking out reverse mortgages to tap into their equity. They're taking out home equity lines of credit to go do repairs in the house and make them more livable as they age. And that's kept a large number of houses off the market. Millennials, it's been interesting. They got started later than prior generations in terms of home ownership for a whole variety of reasons. And in many cases, they skipped the starter house. So they stayed at home living with mom and dad, putting away cash. Now they had the low interest rates. They were able to go out and buy a bigger property. So they went right from staying with mom and dad to buying a 3-bedroom, 2-bathroom, 2,500 square foot house somewhere, which wouldn't have been the normal cycle.
For sure.
But now that we have, a huge percentage of homeowners sitting in a house with a 2.5%, 3% mortgage, who would have to get a 5.5% or 6% mortgage on their next house, there is there's something called rate lock that economists talk about that discourages people from moving. And now you look at home prices and the recent changes in the tax law, and there are fewer benefits to going out and buying a more expensive house in terms of that move up market. So there's a lot of disincentives for people to move right now, and that is keeping a lot of properties off the market. And last point on this, the recent housing starts numbers showed an 18% dip in year-over-year housing starts for single-family homes. So this time the builders did get the memo. They've seen market changes, and they are adjusting their future construction to fall in line with that, so we don't wind up with an oversupply. But the negative part of that is we're still under in terms of the number of houses available compared to demand, and the builders aren't going to fix that right away either.
Yeah, I mean, I've heard anything from 80% drop of certain builders, of people coming in and viewing them and visitors to those builders. So, and I think just like you just said, we have this remembrance of what happened in 2009, 10, 11. So they're going to say immediately, let's stop and let's regroup, and then put a business plan together for the next 2 to 3 years, so we don't get stuck. I mean, I will say this: I have heard recently builders are still buying land. They're still getting prepped. So I just had a developer talk to me. They bought a place in locally, Fountain Valley, for $25 million, and then one of the big builders came in and wanted to buy it for $50 million from them.
Well, look, the old saying in the real estate industry is God isn't making any more land. So and builders will do that, particularly in markets like Southern California, where land is scarce for building, particularly appropriate land for building, where you don't have to go into gyrations to make it work. So we are seeing that, and keep in mind too, because of supply chain disruption and labor shortages, it takes builders longer to build once they get started.
Yeah.
So there's nothing wrong with them, getting permits, buying land. But I think they're being very judicious about how they start construction. And look, it's going to vary in every market across the country.
Sure.
There are just some markets where you're not going to see any building for a while.
Mm-hmm.
And there are other markets where, in a particular spot, there's clearly enough demand to warrant continuing to build.
Yeah, no, I agree. It could be, in Alabama, it's going to be different than here than it is going to be in Illinois and New York. So I agree with that.
And a lot of those builders, by the way, are moving over to multifamily construction.
Oh, really?
So we had an 18% drop in single family housing starts last month, but we had an 18.5% increase in multifamily construction. So the builders, I believe, have also correctly assessed that these affordability problems aren't going to go away anytime soon when it comes to buying a house. So there's a lot of people that would have liked to have bought a house who are now going to temporarily be renters and need a place to live. So I think we're seeing the market adapt to changing conditions, which is a good thing.
Do you think that well, at least is kind of the same thing, or at least they're reading into this renters nation? I know that's a coin term that people have brought up, but do you think that they've went to multifamily because of that? Because now they're hearing, okay, well, hey, or they're seeing it, and the last 10 years, things have changed. But have you guys done data or research on that, where we're pushing towards a renters nation? I know I've heard that for, I would say, the past 5 to 7 years of renters nation, and it's ticked up even the past 2 years because of affordability has gone up. I mean, affordability has been reduced. So I see that, and I could see the builders, they have, as much data as you, and they're, large companies that make a good amount of money. So they want to make sure that they're making those decisions properly. So do you see that too?
No.
Okay.
No, that's one of the longest running urban legends in history. That's right up there with alligators in the sewers of New York.
Okay.
And pick your other ones. But will there be more renters? Yes, but there will also be more homeowners. So the fact of the matter is, while everybody has been breathlessly talking about how we're becoming a renters nation, homeownership rates have actually gone up over the last 10 years. So and not a lot, but we've gone from about 62% home ownership rate, 62.5%, to about 64%. So, a renters nation to me is when we're at more than half of households nationally being renters. And that's the case in some countries, but the U.S. has always had a fondness for home ownership, and our home ownership rates tend to be very high relative to other parts of the world. And as I said, despite all of the rental inventory that's come on board, look, single family rental properties have doubled since 2019. We went from more than doubled. We went from 9 million to 19 million in the last decade plus. But during that same period of time, we've seen more homeowners and a higher percentage of households being owner occupied. So no, I don't think we're in any danger of being a renter nation.
Okay. Yeah. I mean, I know you're deep in the weeds on that stuff, so you're able to see those numbers, or at least look through those numbers, and that's good information, because just like the recession and everything else, you hear one thing and you kind of hold that to gospel, if you will.
I think the way to look at it, Peter, is there are, for your investors, there are a lot of opportunities to provide rental properties because a lot of people are going to be looking for them.
Yeah.
Particularly in markets like Orange County, where home ownership is just so expensive.
Yeah.
I mean, it's expensive to rent too, but home ownership is crazy expensive here. So in markets like that around the country, you see a higher percentage of rental properties than you do owner occupied properties. True in Manhattan, true in San Francisco, true in Miami, true in Los Angeles. It's true in most big cities.
Yeah.
And expensive areas. So there's lots of opportunities for your investors who own rental properties. But the reality is we're seeing both more renters and more homeowners enter the market. Okay. So it's not an either or scenario, it's an and scenario. There are opportunities to buy a house, fix it, and flip it to a prospective owner. And there are opportunities to buy a property and convert it into a rental unit.
Yeah, no, for sure. That's good tangible information. That helps out a lot, especially clarity on home ownership and everything else, because I know that that's always been a key piece of at least the last 10 years for me, what I've heard and everything else. Where do you see, going forward with data and everything else, just because that's your wheelhouse? What do you kind of see data for real estate and real estate professionals in the next 2 to 5 years?
A lot of the data that we have is data that's been collected for almost since the beginning of the country,
Mhm.
in terms of property records. That said, I think we're in the infancy of how data is used in day-to-day real estate operations. I do see more companies, more government entities digging into this data to help determine development needs, insurance companies determining whether they want to write policies in certain areas, mortgage companies trying to figure out where they might be at higher risk lending, not because necessarily demographics, but because of real estate trends. So I think we're in the early stages. I don't think there are a lot of artificial intelligence or machine learning applications that are spitting out the kind of useful information that we'll ultimately get from combining these different data pools. But I'm heartened by the fact that I am seeing individuals, whether they're investors, mortgage officers, real estate professionals, starting to tap into this data and use it for educational purposes, but also to drive their businesses forward. So in the infancy, but I think it'll be a more and more important aspect of what we do as we move forward.
For sure. No, I agree. Well, Rick, I'll transition. I know you're a busy guy, so I want to make sure that I'm appreciative of your time. So, I have a couple last questions for you. What do you guys use at ATTOM that's a good resource or a good online resource that helps you guys be more efficient at maybe collecting data or running the business a little bit better and easier?
You would be surprised how manual data collection processes still are.
Okay.
And what we do, this is going to sound like a sales pitch. I don't mean it to. What we do is that heavy manual labor so that our customers don't need to.
Yeah.
So we've built delivery tools that streamline the process, whether it's an API or a cloud-based system, because this is still such. You have to collect data from 3,410 counties across the country, and a surprising number of them are not online yet. So there aren't a lot of those tools. For our own business, I mean, we use things like Slack, we use things like Salesforce, kind of well-known brands that our sales and marketing and development and operations teams use to stay connected. And that's been really important. We're big Microsoft Teams users. It's been important to us because we're a virtual company. We have a really nice office in Irvine that almost nobody uses. Because most of our employees prefer to work from home, and management's been accepting of that because our productivity has stayed very, very high. So it's those kind of tools we use collectively that kind of help us be a little bit more connected, stay in touch with each other, and make sure our business processes continue to flow nicely.
Nice. No, that's good info. What about a book that you've read? Doesn't have to be real estate, just a business book or something for work that has really helped you or given you some more perspective.
I'm going to go old school on you because
Okay.
I've been around since Gutenberg invented the printing press. One of my Bibles is 7 Habits of Highly Successful People.
Oh, okay.
And I go back and touch base with that book periodically.
Yeah.
I highly recommend it to anybody who's interested in that sort of thing. It's good from both a personal perspective and a business perspective. And a lot of the things that Stephen Covey, the author, covered in that book are fundamental. But I know from coaching Little League for 10 years that knowing the fundamentals and being solid there, are really what lets you succeed at more complex tasks. So that's one. The other one, and this is from my marketing days, is another old school book called Crossing the Chasm by Jeffrey Moore.
Okay.
And it really talks about how technology gets adapted, but is something you can apply to any sort of disruptive or potentially revolutionary change in business models. But it's still a good read, and a lot of the concepts that Moore talks about are still in play today.
Okay. Okay, cool. I haven't heard that one. Well, cool. Well, Rick, where can people find out more about you?
Well, I would encourage them to check the ATTOM website. It's ATTOM data, atomdata.com. There's a link at the top of the page that says Insights, and we publish free reports pretty much every week, sometimes a couple times a week.
Okay.
Nothing for you to buy there. Just log in, take a look at the reports, and dig to your heart's content. If you want to follow me on Twitter, my handle is Rick Sharga, really easy to find. And also feel free to reach out to me on LinkedIn. If you do, mention Peter's podcast so I know where we know each other from. I get a lot of really interesting linking requests on LinkedIn, and I've stopped automatically linking to everybody because God knows where some of these people are coming from, but I don't. So just let me know where I've heard of you. But I have a lot of followers on LinkedIn, and I'm posting this kind of real estate information constantly.
Okay, cool. Well, Rick, I appreciate your time. Thank you so much. It was, for one, it was exciting to get you on here and talk a little bit more about the housing market and everything else, just because your knowledge base is so vast. Thank you.
Hey, us Orange County guys got to help each other out. So good luck with the podcast, and I hope we'll do it again.
Okay, sounds good. Thanks, Rick.
Take care.